If you go back and study Bitcoin history, there is really a clear pattern around its halving cycle. Every time since 2012, the same things happens. The halving year is kind of slow and build-ups. The year after halving, that's when the price really take off. Then after that, we get a bear market that lasts about a year before the next cycle starts. This played out in 2013, 2017 and 2021 almost perfectly. But this time, something just changed. So here is the key shift. 2025 was supposed to be a breakout year, but it didn't follow the pattern. And which tells us one thing, the cycle is already different. So what will be the likely reason? Maybe the institutional money come early, like back in 2024, like through the Bitcoin ETFs. So the move we expected in 2025 may have been already happened in 2024. And that leads to the real question. If the cycle shifted forward, does that confirm a late 2026 bottom or does it invalidate it? That's what we are breaking down today. Alright, let's walk through the data, starting with the first chart. This is the MVRV Z-Score for Bitcoin. Now don't worry about complicated names. Here is what actually means. It tells us whether Bitcoin is expensive or cheap compared to people what actually paid for it. When it goes into green zone, like below zero, it's where the Bitcoin has already bottomed. That happens in 2015, 2018 and in 2022 as well. But here's the interesting part right now. The score is sitting around 0.47 right now. That's literally neutral, like not cheap, not expensive, like just in the middle. So what does this mean? There are two ways to read this. The first possibility will be maybe the bottom isn't in yet. In past cycle, we saw this metric go below zero before a real bottom formed, and that hasn't happened yet. So this could mean Bitcoin has one more drop left, maybe somewhere in the 50k to like 65k range before we see a true bottom. Second possibility, the cycle is different. Because of the ETFs, big institutions are holding Bitcoin at much higher price, like around 80k on an average, and that might be acting like a flow under the market. So instead of big crash, we get a more controlled downturn and Z-Score never goes deeply negative like before. So here is the key takeaway. The data doesn't give a clear answer yet, but since we haven't seen a clear bottom signal, the idea that the real bottom comes later, like around late 2026, is still very much in a play. Alright, now the second chart is one that really changed how I see the cycle. Again, this is about Bitcoin, but from a different angle. What you are looking at are two things. On one side, the new Bitcoin comes from the miners after halving, and it's about like 450 Bitcoin per day. On the other side, the money flows into Bitcoin ETFs since early 2024. Now here is a key point. The miner supply is basically flat. At current price, that's roughly $30 million worth of Bitcoin entering in the market every day. But in the case of ETF flows, on a big day in 2025, they were bringing around 500 million or even a 1 billion in a single day. So think about this for a second. That supply shock that used to drive these cycles is now tiny compared to the money that institutions can move in just few hours. And this is where things really changes. If the ETF flows are main drivers of price, then the Bitcoin cycle might not be controlled by halving anymore. Instead, it could be controlled by institutional money flows. And those flows depends on things like interest rates and Federal Reserve, not the halving schedule. So here is the big idea. The cycle structure is still there, like the people behavior, long-term holders, on-chain signals. But the engine that driving the timing, that may be completely changed. Alright, so this is where we test the idea. If we are saying bottom could come around in October 2026, the data need to confirm it. For that, we need to look a couple of data. In that case, the first one, MVRV Z-Score. Right now, it's around 0.47. In past cycle for Bitcoin, the real bottom only comes when this went below zero. So if it's dropped negative, the bottom is likely in. Second, the ETF flows. Institutions have been buying, but if that flips to consistent selling, then that removes the support and opens for deeper drops. And the third, macro. Keep it simple this way. If the Federal Reserve keep rates super high, in that case, the liquidity will stay tight and bottom likely will be later. On other case, if the Fed start cutting, the liquidity will return. In that case, the market moves much more earlier. So the rule is simple. The tight macro is equal to later bottom and easy macro earlier bottom. Now here is the key. If we see the strong ETF inflows and MVRV staying above zero and at last and macro easing, then the bottom is already being around 60k. And the October 2026 idea doesn't hold. That's the framework. There are signals that will prove this is right or wrong. If I get into much more deeper, I actually landed into much more precise content. And I want to slow down this part because the surface view of this market is actually pretty misleading right now. But here is where this cycle gets different. We are not seeing the same level of panic And big reason for that is the institutional involvement. Like large players, ETFs, funds, long-term holders are accumulating at higher price. The market is rising. And that changes how we read the MVRV. Because MVRV is based on the cost basis. So the institutions will buy and hold that effectively lift the flow of the market. So what that means in a practice? In past cycles, you need a deep crash to push the MVRV below zero. But in this cycle, that kind of deep correction may be absorbed before it happens. So instead of sharp capitulation, we may get much more compressed reset, where the price stabilizes higher and MVRV never fully gets negative. So the key shift is this: MVRV is no longer a fixed signal and it's being influenced by changing market structure. Which means, yes, historically we will expect a deeper drop, but structurally the drop may be now limited, and that's why this cycle is hard to read. Now let's move to the second layer, and this is where getting things complicated, because structurally the cycle looks very different from anything we've seen before. Here is what the data is showing. First, the amount of Bitcoin sitting in the exchanges has dropped a lot. Now it's around 2.7 million BTC, the lowest level in years. That means less supply is available to sell on the market. And second, long-term holders. They now control around 75% of all Bitcoin. And importantly, they are not selling even during the volatility. Third, the whales are buying. The wallets that holding higher amount of BTC is now increasing. In just few months, they have added tens of thousands of BTC. At the same time, the retail investors are doing the opposite. They are selling, taking the losses and exiting the market. So what the pattern does this create? Retail is getting out, big players are accumulating, and supply on exchange is shrinking. That's a very specific setup, and that's what people call smart money accumulation. And this is where it challenges the first layer, because traditionally, a true bottom requires a big panic sell-off, a deep flush. But in this case, the stronger hands are absorbing the selling before it turns into a full collapse. So the one possible conclusion here is that maybe this cycle doesn't require a deep crash to bottom. Maybe the flow is higher this time because of the structure of the market is changed. And that's why this is tricky, because now you have on-chain data suggesting more downside could happen, but structural data suggesting strong support underneath. And those two signals are pulling in an opposite direction. Now let's move to the third layer, and this one might be the most important one, because this is neither a cycle chart nor the on-chain data, it's liquidity. The idea has been strongly argued by Arthur Hayes, and his point is pretty simple. Bitcoin didn't struggle in 2025 because of crypto-specific reasons. It struggles because there wasn't enough money in the system. The Federal Reserve was tightening, pulling liquidity out, and when the liquidity is out, the risky assets like Bitcoin tend to struggle. But here is where things shift, and why 2026 matters. The US has a massive amount of debt, like around 9 trillion, and it needs to be refinanced in 2026 itself. Now think about this problem. If the rate stays high, the refinancing that debt will be very expensive. But if they push the rates even higher, something in the system could break. So what's the alternative? Inject liquidity. Put more money into the system to keep things stable. And this is the key idea. If the Fed is forced to add liquidity, not because of it wants to, but because it has to, then that could change the entire Bitcoin cycle. Because think about this setup, the supply on exchange is low, long-term holders are in selling, and institutions are accumulating. So if a wave of liquidity comes in, there is not much supply available. And that's create a very asymmetric move. It's not because of the cycle signal is just triggered, but because of the money entered in the market. And this is why this layer matters so much. It suggests that timing of the cycle might not be driven by halving anymore, it might be driven by liquidity. And that's exactly the point where Arthur Hayes has made. The strongest part of next bull run could happen between mid-2026 and mid-2027. Not because of halving, but because of the liquidity comes back. So if that's true, the market moved before the traditional bottom signal ever appeared. So where does this leave the October 2026 idea? It still will be the most likely outcome, but it's no longer a clear thing at all. Here is why. First, on-chain data. Bitcoin hasn't fully reset, like MVRV is still above zero. Price hasn't reached the deeper cost basis. So a move towards 54 to 60k is still possible, and that support a later bottom. Second, the market structure. Supply is really tight. The long-term holders are in selling and institutions are accumulating. So instead of a sharp crash, we may get a compressed downside. Third, the liquidity. This is the wild card. If the Federal Reserve keep things tight, bottom will be likely later. If liquidity turns earlier, then the timeline shifts forward. So what I am watching here, the 10-year Treasury yield. If it starts falling due to the liquidity, not just because of the weakness, that's the signal. Because when this happens, Bitcoin usually moves 3 to 6 months later. So here is the bottom line. The cycle isn't broken, but it definitely evolving. The old playbook, just follow the halving and wait, that's no longer enough. Right now, Bitcoin is driven by three forces at the same time, like the on-chain signal that's pointing to the later bottom, a supply structure that's stronger than ever, and a macro liquidity cycle controlled by Federal Reserve. And whichever one of these takes the control, that's what decides when the real bottom will happen. So this is not about predicting one data. Instead, it's about tracking the signal that move the data. And right now, the most important ones are simple. MVRV, like has the reset happened? ETF flows, is institution money staying or leaving? And liquidity, is money is entering into the system or not? That's the game. So if you found this useful, subscribe and follow along, because every week we are going to track the exact signals in real time, and we will see which direction where the cycle is actually breaking. Because in this market, the edge isn't about guessing, it's about updating faster than everyone else.